So you're watching the Nifty 50, trying to figure out what's really driving the moves.
Yeah.
Yeah. It can feel like just a wall of noise sometimes.
It really can. That's where something like Bollinger Bands comes in. They're a great tool to help, filter things out a bit.
Right. Filter. So this deep dive, we're focusing just on Bollinger Bands.
Exactly. We'll break down what they actually are, touch on how they're calculated, don't worry, no heavy math needed, and really focus on how you might use them for trading the Nifty, even if you're like totally new to this.
Okay. And we've got some hypothetical Nifty data to walk through.
Yep, hypothetical daily closing prices. Just makes it easier to see the mechanics in action. The main goal here is that by the end, you'll have a solid grasp of the basics and how these bands could potentially help spot trading ideas.
Got it. So starting simple then, what's the main job of these Bollinger Bands? What do they actually tell us?
Well, their core purpose is really about gauging volatility. How much is the price jumping around? They also give clues about whether the market might be overstretched, too high or too low, maybe.
Okay, overstretched, like potential turning points.
Potentially, yeah. Or maybe suggesting a trend is likely to continue. They give you a visual feel for the market's energy.
Interesting. And what are they made of? You see these three lines on the chart.
Right, 3 lines. The one in the middle, that's your baseline, a simple moving average, or SMA, usually calculated over 20 periods, like 20 days.
Just a standard average price.
Pretty much. Then you've got the upper band, that's the middle band, plus 2 times the standard deviation.
Okay, and the lower band is minus 2 times.
You got it. Middle band minus 2 standard deviations. That 2 times factor, the standard deviation multiple, is key. 2 standard deviations statistically covers something like 95% of normal price movement.
So the price should usually stay within those bands.
Most of the time, yeah. That's the idea. Standard deviation itself just measures how spread out the prices are from that middle average line. More spread means higher volatility.
Okay, so if the price is inside the bands most of the time, what signals should we look for?
Well, if the price gets near the upper band, that could be a warning sign. Maybe it's getting a bit ahead of itself, overbought perhaps. Could suggest a pullback.
And the opposite for the lower band.
Yeah,
Oversold.
exactly. Price near the lower band might suggest it's oversold and could be due for a bounce. Then there's something called a squeeze.
A squeeze, what's that?
That's when the bands get really narrow close together. It shows volatility is super low, and often that low volatility period is like the quiet before a storm. A big price move could be coming.
You don't know which way it'll break.
Not from the squeeze alone, no. And the opposite is band expansion when they widen out. That means volatility is picking up and often suggests the current trend might keep going.
Right, let's connect this to that hypothetical data. You mentioned the middle band, the SMA.
Yeah. So using our example, for day 20, the 20-day SMA was calculated at 22,398. Then for day 21, it nudged up to 22,433, and day 22, it was 22,463. It just rolls forward, averaging the last 20 days each time.
Okay, makes sense. And the standard deviation part, how did that look?
So that standard deviation, measuring the price spread, was about 411.76 for the period ending day 20. Then it dipped slightly to 407.23 for day 21 and 403.96 for day 22.
So it decreased a bit. Less volatility in those last couple of days.
In that little snapshot, yeah. Slightly less spread around the average. And that changing standard deviation value is what makes the bands dynamic.
Because the upper and lower bands use that value.
Precisely. For day 20, you take the SMA, 22,398, add 2 times the SD, 2411.76, subtract 2 times the SD. That gave us an upper band around 23,221 and a lower near 21,574. See how they widen or narrow based on that volatility measure?
Yeah, I see it. They adapt. Okay, so bringing it back to actually trading the Nifty.
Yeah.
How does this help someone make decisions?
Well, first, just look at where the price is relative to that middle SMA band, generally above it. Might suggest an uptrend, like on our day 21 and 22 examples, mostly below. Could indicate a downtrend.
Simple trend indication. What about those outer bands again?
They act as sort of potential zones of interest. If the Nifty price on day 21, say, started pushing towards that upper band around 23,247, a trader might think, maybe this rally is getting stretched. It's a caution signal.
And that slight narrowing we saw in the standard deviation, that slight squeeze.
Right. Even a small narrowing like that hints that energy might be building for a potentially bigger move later on. It puts you on alert.
You also mentioned combining these bands with other things.
Absolutely. Bollinger Bands are often more powerful when they aren't used in isolation. For example, imagine the price touches the lower band and you see a bullish candlestick pattern like a hammer shape. That's often seen as a stronger buy signal.
Okay, confirmation from different tools.
Exactly. Or you could check an indicator like the RSI to see if it also confirms an overbought or oversold reading when the price hits a band. And, people use these on daily charts for swing trades, but you can apply them to shorter charts like 5 or 15 minutes for intraday stuff too.
Got it. So for listeners maybe just starting to explore this, what are the key things to remember?
Okay, number one, don't panic about the math. Your charting platform does all the calculations and draws the lines for you. It's about interpretation.
Phew. Good. What else?
Number two, and this is crucial, practice on a demo account first. Use paper money. Get a feel for how the bands behave with nifty prices before you risk real capital. Seriously important.
Demo trading. Always good advice.
Yeah. Then, risk management. Always. Decide how much you're willing to risk per trade. Use stop losses. Maybe placing a stop loss just outside the opposite band could be one strategy to consider.
Protect your capital.
And fourth, explore combinations. See how Bollinger Bands work alongside other indicators you might learn, like RSI or MACD. Often the best signals come from agreement between different tools. And finally, maybe look back at historical nifty charts that's called backtesting. See how the bands looked during past trends, past reversals. It helps build intuition.
Okay, great summary. So fundamentally, Bollinger Bands give you a valuable lens on market volatility and potential turning points or continuations, specifically here for the Nifty 50.
They really do offer a useful perspective. And, thinking about how they flag potential volatility and reversals,
Yeah.
it kind of leads to a deeper question for you to consider.
Oh, what's that?
Well, if the bands are showing you that volatility might be picking up or a reversal could be brewing, how might understanding the reason for that potential volatility, maybe it's big economic news coming out or some global event, how might understanding that why help you refine your trading decisions even further? Food for thought.